Hello, welcome back. Today, as a real estate investor who's been doing it for 3 decades, I've been doing real estate investing for over 3 decades and coach thousands of students and investors and clients how to build real estate wealth through income property. I'm no tax expert. I'm not a lawyer, but I've been through the school of hard knocks. In a moment, I'm going to play a short video, maybe 20 seconds, just goes to show you the wild west of social media and how some misleading, totally garbage, totally inaccurate, 100% information, the contents of being put out there in YouTube and other social media content and Instagram. And yet the information sounds so good, sounds so sexy, so enticing that it creates views. It creates a lot of views, a lot of subscribers, and it's just bringing. But if you talk to a real expert, like a real attorney or real financial planner or a real tax expert who is licensed in their respective profession, who is highly regarded, and they give this kind of review of this garbage being put out there around financial contents and real estate contents, what have you. I find this is so hilarious. I'm very much aware of what's going on. I've been through the school of hard knocks. I've done a lot of real estate transactions, and I'm no expert, but real estate investing, I know. And this topic, let me share this short with you. This short was produced by this typical YouTube real estate influencer, if you will, who talk a great game, got a lot of views. And then this attorney, which I respect, actually, this woman, she gave a very good review, and I might as well give another review of mine, another comment. So with that in mind, let me go ahead and share this, and here we are. Here we go.
If you transfer your home into your kid's name or leave it to them in your will, you're doing way more harm than good. When you've owned your property for a long time, the property value has appreciated a lot. So if you passed your property to your kids in your will, they're responsible for paying all of the capital gains taxes on your property. Instead, you need to put it into a living trust. Name your kids as the beneficiary. So when you're gone, they inherit the property tax-free through the trust. It is a special code called a stepped up in cost basis.
You, the public, gave 20 million views to this video on Instagram for what is straight up hot garbage. And this is why, ladies and gentlemen, there is made up shit on the internet. Leading a property to a will gives you step up in basis through our standard Internal Revenue Code 1014, and putting your property in a living revocable trust does absolutely nothing to change that. And for actual tax law from a tax attorney,
I respect this lady, this very credible tax attorney. She have a lot of credentials. She's very popular on YouTube as well. Her name is Jennifer DeLucci. She's right. She's giving some very good review because she's a practitioner. Let me give my 2 cents in there as well. Again, I'm not a licensed tax or a legal professional, but I play one on TV. No, I don't do that either. Here's my 2 cents. Look, I help. Let me give you some roundabout ways of reaching my conclusion. I help for 3 decades. I help real estate investors to create a real estate portfolio. I help them buy income property and then hold it long term, allow the property to appreciate over, let's say, if the property appreciates 4 to 6%, if you will, on an annual basis, their property, investor's property, will achieve around, let's say, around 50% loan to value, if you will. No, you put 20 to 25% down payment to finance an income property. That's the upfront you buy. Then, whenever your property or properties appreciate in about 5 to 8% annual basis, sometimes more, depending on what market you buy. And sometimes you get lucky, the property you purchase skyrocket quite a bit from time to time over the decades. The point is, my investment philosophy is buy, refi until you die, then pass on. Pretty much at a tax-free basis in your lifetime, so you can pass on your properties to your loved ones, generational wealth transfer. As a matter of fact, I could even go as far as multi generational wealth transfer. What I mean by that? If you're able to buy new constructions, newer homes that can cash flow, you buy it on a consistent basis, one rental at a time. Over the next 10 years, if you're able to buy 10, 15, 20 properties of single-family homes, or maybe up to fourplex, and then buying good market, cash flow market, affordable markets. If you want more to learn more, please become my email subscriber. You can subscribe with your email on my website below. Hear me out. If your property appreciates 6 to 8% in the next 3 to 5 years, you already have 20% loan to value, LTV. In 3 to 5 years, if each of your property grow 3, 4, 5, 6, 7%, in about 4 to 5 years, each of your properties have like 50% loan to value. Then you can cash out refinance to buy more rental property. That's the ripple effect. That's how you use leverage. That's how you scale your real estate portfolio. So then you can buy more. You cash out refinance to buy out from one property. You can buy 2 or 3 more properties depending on the equity you have from a particular property. So over the course of 10, 15, 20 years, your portfolio of income property, you can do a cash out refinance at a loan to value of 50%, somewhere around that. When you do a cash out refinance, it's a tax-free event. When you borrow against your property, it's a tax-free event. You pay no taxes. You'll be able to scale to buy more cash flow properties, single-family home, duplex, triplex, fourplex, or even multi-units beyond 5 units. And then you keep on repeating the process, keep on refinancing, tax-free event. You can scale, buy more cash properties. And then in the future, you keep this property, maintain the growth. Throughout long term, you get increasing cash flow, you get appreciation, you get tax benefit, you get the renter to pay down your loan and the whole 9 yards. Then when you pass on, years and years later, hopefully, you accumulate millions of dollars of real estate. Then when you pass on, then your beneficiaries will inherit those property tax-free. Is called step up in basis. All the years of appreciation, when you pass on, your beneficiaries, they inherit the property at a step up in basis at fair market value at the time of death. Let me take it one step further. If your beneficiaries, after they inherit the property, one day after they inherit the property, if they were to sell those property, for whatever reason, they pay no capital gains taxes. So the concept that's been preached, that's been used by wealthy people for decades. They buy an asset. Doesn't have to be real estate. It could be any asset. Stocks and bonds, hard assets, soft assets. They buy, they cash out refinance. I love real estate, so I'm going to talk about real estate. Cash out refinance, tax-free. You leverage your equity to buy more income-generating property for years to come. And upon passing, then your beneficiary get the money, get the assets tax-free. It does not matter whether you have a will or a living trust or any kind of trust. That does not matter. The beneficiary, this video, that young punk that producing garbage for the video we just saw, he have no idea what he's talking about. What he's saying is that if the beneficiary get the assets on a step-up basis, if it is on a will, you have to pay taxes? No. It doesn't matter whether you have a will or a living trust, or you have no wills and no living trust, which is a bad estate planning on the part of the beneficiaries. Still, you could still get the property tax-free. It's just that without a will, you have to go through the probate. You go through probate, it takes a year, 2 years, and the lawyer will add the probate costs in this. And it takes a while for the assets to transfer to the beneficiaries without a will or living trust. A will, if you have a will, you have the ability to control who the money is going to go to upon death, instead of the government control it for you, instead of the government to dictate which one of your beneficiaries or get the asset. But with a living trust is just merely to avoid probate. So you can living trust allow the beneficiaries upon death of the owner to get the money quickly without going through probate. That's what a living trust is. All right. I know I'm making a long story short, but I have a reason to expand my presentation beyond that little short clip. The takeaway is be careful what you hear out there in the social media. People talk a good game, talk real estate or financial stuff. A lot of these people are fake real estate gurus. They're just marketing. Look, they're YouTube influencer. They don't have any credibility. They don't have any background. They don't have any understanding of financial or real estate topics. That's my takeaway. That's at the end of the day, my recap is be careful out there. This is the wild west of the social media. Anytime you receive financial contents, real estate contents, just be wary. There's a lot of propaganda out there, a lot of misleading information. It's just, in fact, most of this information is very inaccurate, misleading. And if you follow these kind of advices, you are doomed. If you follow the fake real estate gurus out there, if you follow the social media contents of those trash young punk out there getting a whole bunch of views just by talking crap and talking shit out there for this short video. With that said, thank you for watching. If you receive any value from this video, please like and subscribe. And better yet, put your email on my website below so you become a free member of our real estate investing community. So you will receive very credible, very reputable free real estate contents about real estate investing from myself, Seewing Yee, and my network and thousands of my members within my real estate community. Thank you so much for watching and listening. I'll see you next time. Bye-bye.